And joining me on the podcast right now, and in super technicolor with a white background, their big smile, it's Paul Hill, full-time smiler, full-time equity analyst, and full-time investor. He's full-time, all the time, full-time. Paul Hill. You all right, fella?
Well, thanks for the introduction. Morning, Justin.
Yeah, but you know what? The markets are always interesting. I always say this, to everyone. Get involved with it. It's funny how more people are coming to the market just because they've, been spending more time at home trying to find things to do. And Robinhood has blown up in the US, and it's more traffic over here. I mean, I noticed Vox. We had a weekly meeting. The traffic to Vox Markets has gone up massively. So it's good to see more people getting involved. I hope they don't go crazy and go into sort of super risky stocks at the start and blow their accounts up, because that's not the way to start. It's not bad to have a bit of a loser though when you first start. Having a big win at the start can be dangerous, can't it? Because then you think this is easy, and I mortgage my house and put it on the next term.
You made a great point. I'm actually a bit concerned because there's been so many people from the Robinhood brigade and also with Reddit and these day traders and stuff, because they've never really invested at all, but they've been locked down, and as of March they've had a one-way bet because the markets have just gone vertical. They've made a shed load of money. They think it's easy, and all you need is a wobble. And you could get a few of them because what it does, it lulls you into a full sense of security. If you make a lot of money quite quickly and straight away, then the danger is you become a bit sort of like complacent and maybe a touch arrogant. And if you do that, then you'll make some big mistakes, because you end up then sort of like you're not managing your risk profile. And what happens is that you get you decide then, right, okay, I'm good with these single stocks, and I've put about, I've put half my salary in and done really well. I've made say $500,000, and then all of a sudden you decide to put $500,000 on, I don't know, GameStop at $500, and then it all comes horribly wrong and it unwinds. So I'm with you. You just got to be careful, because if you're very new to this game, then the markets can change very quickly and do weird things. And the one thing that upsets a lot of people, including me, and probably even you, Justin, you're a cool cookie, is that when you get these black swan events, unknown unknowns, i.e. stuff that really goes, it's got tail risk probabilities. But these things happen, and we got a shed load of them last year, and we're going to get plenty going forward. And when you have things in the markets that do things that are very, very unusual, I mean, let's be clear about it, even the really smart professional traders get caught out. We had Nick Leeson back in the 80s when I was, when you and I were around, who blew up bearings. We had Jerome Carovial who took down SocGen, and then we had the head of the chief investment officer of JP Morgan, the London Whale. I think he lost $6 billion. So
look at Neil Woodford. Let's be honest, he was a good fund manager, but he stepped outside his comfort zone and into small, sort of risky liquid stocks, and all of a sudden people started, selling. And he didn't know what to do with this. Stocks went down, and then selling begets selling. That's the trouble. And when everyone starts running for the door, that's when it starts to get panicky. And that happened back in March. Everyone started running for the door at the same time. And luckily, I think I was nowhere near fully invested, but it was a bit scary because it's so quick, that sell-off. And for any newbies in the market, I think most of the newbies have come in since then. And like I say, it's largely been a one-way bet. Any stock you look at, post that March sell-off, you could have doubled in big stocks, small stocks, and more than that. So you've got these guys. So it's very easy, very easy. When you think it's, you can't lose. And like you say, you back up the truck and you take on leverage and you borrow some money and you say, listen, guys, honestly, get your friends involved and your family involved, get your brother-in-law involved. Listen, it's a one-way thing. And they all chuck it in. And like you said, that saying, everyone is in one side of the boat. The inevitable happens. So you've always got to have a bit of an eye on the risk and stuff, and be a bit careful. So
you've had a wobble on some of the high octane stuff out in NASDAQ in the last few days, and I mean it's come down 5 or 10%. Things like your Teslas, your Snowflakes, and these kind of guys. But the big point for long-term investors, the point to remember is this is actually happening with a strengthening economy. The NASDAQ's gone down on a strengthening economy. It's not on a weakening economy. And all that is just multiple compression. So if you're in sort of like, sort of like more value orientated stocks, then you've probably done okay. I mean, my portfolio has been totally flat. In fact, it's like gone up slightly, but it's really sort of like these high octane stuffs that get bid up and bid down, high volatility. And I think you've banged the table many a time. You need diversification. You need basically some of them, are good steady eddies, but all equally you need something to be able to sort of like give you a bit of alpha, which is your, some of your stocks. You can't have, well, you can, but you've got to take, if you're going to have everything of all the same type, if you're going to have a Zooms kind of stock and have 12 of them in your portfolio and there's only those type of stocks, then you've got to expect it's going to go up quick and it's going to go down quick. And you're going to have huge amounts of daily change, because that's what happens.
Yeah, I mean, I looked today. 1, 2, 3, 4, 5, 6, 7, 8. I got 8 stocks. I had to count. I thought it was 9, but no, it was 8. And I got 2 risers, 2 non-movers, and 4 falling a little bit. The biggest fall is like 5.5%, pretty much. That's Ilika, but it doesn't matter. It's balanced up because my top riser is up so over 7, 8%. So, and the other one's up over 3%. So it's it's not much movement in the portfolio now. If I just own the one Ilika hot stock, EV stock that I see is going to power ahead, then and I had all my money in that. And that'd be quite worrying because it's dropped a couple of times in the last few days, and it's come off with Tesla and all that as well. It's following that sort of trend. So yeah, that'd be quite worrying. But because I've got other stocks in there, it's fine. So largely half of my portfolio is flat or up, so it's fine. So yeah, and you got
I mean, we might as well just touched on it. Ilika, etc. I mean, they had an update, didn't they, on one of their manufacturing facilities?
Yeah, so they've got 2 sectors about it. Everyone's excited about the Goliath batteries. These are the big batteries for EV. They're a couple of years off yet. But there's lots of articles. In fact, I tweeted one a day saying that the future for EVs is solid state, because they can hold charge 5 times as longer. They're not as dangerous as far as they don't blow up. They haven't got sort of that liquid sort of stuff inside them. They're also fast charging, so range anxiety is no problem either. All that stuff. So, but yeah, they've got this. But they've also got Styriax, which is small med tech devices. These are tiny solid state batteries you can put in these medical devices. They can self charge for years and years. And so you put them in the body or something, they'll stay there for years, or in extreme temperatures,
or something like that.
Yeah, or extreme temperatures, climates. You put using there as well. They don't have to be. There's very low maintenance levels on them. Once you put them in there, they stay there for years, and they're very efficient. So that's what they're doing. They're manufacturing that. They're bringing this manufacturing sort of plant up to speed. And by the time it's up to speed, it'll be 70 times increase in the production capacity. So that'll be second half of this year. It'll be sort of built, and then they'll start producing pretty much next year. They did say I don't know why they say this. The company's been made aware that some construction material suppliers are experiencing supply chain delays, particularly from Europe, which the company is managing in order to minimize any impact. They do not believe this will have any fundamental impact. Why do they say it then? It's like, it doesn't have any impact. Why flag up a negative? But it's not going to affect us. Just yeah, but I just think it's going in that direction. What I like about that, one of the reasons why I interviewed these guys, why I invested in these guys, is that they did say after the last fundraise, they got a roadmap to build this first production of Styriax, and it goes into Goliath. But they will, so this cash fundraise will take them to cash flow positive, and I think I quite like that. That's that kind of planning that far off. And so if they do another fundraise now, I'll kick up holy hell, saying, "Hang on a sec, you put that in your presentations, in your final reports, everything. You can't say that and change your mind now." Yeah. But so I like the fact that they've got that sort of foresight, that sight through to cash flow positive, and regardless of where it goes, it is very volatile, But I'm just thinking 5 years on the road, these are one of the most advanced guys. Well, in the UK, they are the most advanced in solid state batteries. So I just think it's a good company to be in for like 3 to 5, 10 years down the line. So,
I think
I'll hold on.
I would agree, as long as you sort of like look at the long term and then you don't mind the sort of short term volatility. I mean, another company that has got breakthrough technology, which I actually spoke to Alistair Smith yesterday, is Avacta. And what I hadn't appreciated, I mean, I was a bit embarrassed really to a certain extent, because I've been a professional investor for 30 odd years and I hadn't really sort of fully grasped the sort of the scale and the opportunity and the flexibility of their 2 sort of breakthrough platforms. I mean, they've got the Aviva platform and they've got their precision platform, and both of them are addressing enormous, absolutely gigantic markets, sort of, multi-billions, And you've got basically their precision platform, which does effectively delivers chemotherapy into tumors, and that's going sort of phase 3 trials and stuff. Sorry, phase 1 trials. And that improves the safety profile of the chemotherapy drug they've got, which is doxorubicin. You know, and what I hadn't realised as well with chemotherapy, it actually is pretty effective in actually reducing the size of tumours. But the problem is it's got a toxicity, and effectively what this drug, what the prodrug does, and using this precision platform, is it improves the safety profile. So it effectively could, if it's successful, rejuvenate the whole of the chemotherapy drugs, because it still is a workhorse around the world, chemotherapy. And it's a $50 billion business, so that's one of them. But the thing which obviously you and I and everybody else has been sort of like talking about is the rapid lateral flow testing, which is obviously for COVID, because they came out with some blockbuster accuracy or more accurate lateral flow tests in a clinical environment about 2 weeks ago. And it's 97% sensitive and about 100% specificity as well. So absolutely perfectly balanced and very high on the accuracy. But what I haven't appreciated with using the Aviva platform, and this is why, you've probably heard yourself, you know, lateral flow tests when you've got, you know, kids at school and stuff like that, they're not very accurate. And the reason why they're not very accurate is because 50% of people 50% of infections occur from people who are pre-symptomatic, and it just doesn't pick those up. But what this does, which is absolutely brilliant, and I hadn't appreciated, these Avivas effectively attach to the spike protein of the COVID, and effectively what it's doing is amplifying the existence of COVID, and therefore, you know, putting like a big flag on top of COVID, and therefore you get this huge improvement in accuracy because it's much easier to see. It's like shining a light onto COVID, and that's why the accuracy is good. And we're talking of a test here in 20 minutes. I mean, it could be an absolute game changer. You know,
I mean, do you know what? I don't know if you follow on Twitter, Miles McNulty. He's worth following.
Yeah, no, I should do that. I agree.
Because Miles is all over Avacta, and he's been over them for a long time before the test came out, and of course that's been a bonus, the share price and everything. But yeah, I think he's an ex-analyst, so you know he
knows his onions,
goes into his stuff, and he's very data driven, and he does a lot of stuff. But if you look on his Twitter feed, you can't be more researched than him. Fair play, he's banged the drum there. I mean, do you know what? I was doing a video I launched my website, pre-launch for Share Pickers, and it's for everyone really. But it's also I'm populating a learning section at the moment, and I talk about risk and reward, and one of the risks, I said, if you're new to the market, if I were you, I'd avoid this kind of, and I talk about the risks and overexposure, but also certain sectors. And I said, one of them is oil and gas, wildcat drills for oil. It's ridiculous. It's a gamble. The odds aren't in your favor at all. They're, you know, from the best you can get for wildcat drills is 3-1, and they probably got 10-1. That's gambling on a horse. So with investing, you should be odds on, on your favor. And another one actually was if you start investing preclinical phase on pharma companies, especially oncology, it's only a 14% chance that they get through to actual commerciality. So I said, you've got to be careful there. I mean, if you get a bit later...
But one thing about Avacta, is the drug they're actually using, the chemotherapy, doxorubicin, is absolutely well known. It's been used for 40 years. So what
you've got to be, I'm saying, you've got to be specific to each company. But what I'm saying is, if you're going to go for either oil or gas, because a lot of people on Twitter do the same kind of, they're in those high risk plays. So if you're going for oil or gas or pharma, go for pharma, because if they do get a successful drug, it does go to the moon generally. With oil and gas, if you did discovery, and this is massive, you don't even get three or four times your money generally on oil and gas discoveries because it's been going down. So I said, if you're going to play the two, go for the pharma, but you have to know your stuff because it's very complex. And if you want to get in, and you reduce your odds greatly by joining in after phase 1 or phase 2, because but then the share price has gone up a little bit then as well. But that's the problem. There's no.
Well, I mean, genuinely, I think this, because the opportunities are just massive. We're just talking huge $1 billion market.
Yeah, cancer's the biggest, most spent on that.
One of these, exactly, just one of these opportunities land out of, and they've got a whole basket of them. Just one of them land. Then it's gone already. The shares have already multiplied by 4, 5, 6 times, etc. You could probably see it doing that again without any problem whatsoever. Simply because if you look at things like Novavax, it's a $20 billion business. If you look at sort of like Exact Science is $23 billion. If you look at sort of like, BioNTech, nobody even heard of that, and that's $27 billion. So it's got huge amounts of runway ahead of it.
Have you heard of Arix Bioscience? I mean, I've been on the podcast quite a few times. They're an investor, big in all these sort of cutting edge, oncology areas. And they've had some of their investee companies had a massive success recently in phase, and they jumped. In fact, have a look at them, research into them. If you want to sort of more a safe play, they're an investment company, and they all do cutting edge bio, and they're big investors as well. But it's Arix is the ticker, but it's worth looking at.
Yeah, just on that healthcare. I mean, you interviewed, I think it was Adam Hill, didn't you, of Oncimmune a couple of weeks back or something. I haven't actually listened to it. I should do, but I did actually catch their interims, and it's sort of like business as usual. They're making good progress on that Immuno Insights platform with the likes of Roche and Genentech, and signing good contracts. And I see the shares have moved up because, effectively people are starting to recognize, again, this is breakthrough technology. And, if you look at sort of multiples that people have been bought for these type of businesses, and you look at Illumina, they bought Grail for 8 billion. And then you look at, there was another one which went for about 2 billion. But if you use the same multiples for Oncimmune, you get £3.50 or £4.
I'll share the screen. At least, in fact, can you? I can't share the screen with you if it's disabled, I think, from your end. But yeah, the share price has done very well. It's gone from like 40 pence back in March last year. Like I said, you do anything, but now it's £2.10. That's nice. And 40 pence, £2. That's a nice return, isn't it?
Well, then the market. I mean, basically, the management team are doing a great job there because that Immuno Insights platform is absolutely world leading. I mean, it's a huge database that's increasing in depth and value by the day because it's increasing in samples, and you can't replicate these because it's just like taking data and samples for years and years and years. So it's
one of those things I didn't really. I mean, I understand it's a good thing, and it's very they've got something there, but it's one of those things I don't really understand, and I'm thinking, right, I understand the platform. Yeah, okay, it seems like you've got this big name signing up with you and using it and all that stuff, so it must be spot on, but I don't really get it. It's one of
there's two things. The world's biggest diagnostics company, Roche, is one of their lead customers, which basically says if they can't do it, it's got to be pretty unique, okay? But what immunodiagnostics is, and this is their bread and butter, okay? It creates effectively flags to be able to say, has your body got a condition, whether that's an infectious disease, an autoimmune condition, before you know about it, and it may be cancer as well, etc. Because effectively what your immune system is doing all the time, and we're doing it now for you, is it's fighting infection, it's fighting antigens, but you don't generally see it, you don't suffer from it, you just get up a day and do your sort of thing. But using autoimmune diagnostics, you can bring forward the diagnosis of that individual with a condition by years, because normally what happens is that people rock up into hospital throwing up blood and they've got metastatic cancer or something, advanced cancer that is, and they can't recover. They've got a lifespan of like 6 months because they didn't know they had it. They have a huge lump or whatever it is. These guys with their immunodiagnostics for lots of conditions, autoimmune, infectious diseases, cancer, all this sort of stuff, by using effectively a panel of flags, it's almost like the Aviva, the Aviva platform, because effectively what you're doing is you're telling people early what condition they've got before they know about it, and therefore you can treat it. You catch something early, you can treat it, but if you catch something late, you're absolutely stuffed. That's wwhy so many people die of cancer, because not many people know about it. It's far too late.
Yeah, exactly. And like you see, when you look at the company there, what the 130 million market cap, the revenues are small, but they're growing. Well, they're growing quickly from a small base. But like I said, that area, that early detection of cancer, is massive. I don't know how it works, but it's very impressive. And just on a general note, when you tend to get a market leader or big company, a well-known company, sign up with a small company, it's always a good sign, always a positive sign. Even in the mining space, if you get big guys coming to start looking at a smaller thing, because they've got a field of people who can look into these guys. They're all highly accredited.
Another example of that, and I own shares in it. It's been quite interesting actually. They've picked up is Equals Group, okay?
Yeah.
And I mean, they do basically B2B e-payments, okay? And just when it comes to endorsements, they've got one B2B2B customer, a small little customer called MasterCard, who decide to use their platform because they can't do it. I mean, what does that say? It says they've got something in there, isn't it? Because these guys, they're not stupid. They spend so much. So I'm absolutely with you, Justin. If you've got a sort of like a small company that's got, I mean, it's like your Ilika. I don't know who the one it's Jaguar, I think it is, isn't it, or something like that. With a
Jaguar and Jaguar on one side that's for high performance. There's also, I think it's Honda on one part, and and also McLaren as well. They're working with
which means one, they've got great technology, but more importantly, that small company then can use it as a huge reference site to go and sell somewhere else, because they just say, you get that sort of halo effect.
Yeah, well, exactly. Anything you get big companies hooking up with, big well-known companies hooking up with a small unknown, it's always a good sign.
Yeah.
And do you know what? I'm going to bang the drum here, but if you look at when I first look at escape rooms, for example, and they're all, we have one on the road here, and it was like independent, it's okay. And then you look at some escape hunt, you realize the BBC hooked up with them with Doctor Who. Now, Doctor Who, and that's a premier brand for BBC. It's millions of followers around the world for Doctor Who. So for them to trust Escape Hunt with that brand to come up with a theme, you've got to understand the Escape Hunt, the branding wise, are premium. They're not going to trust it with anyone, because Netflix did the same with one of the series. But again, those kind of associations with bigger brands and bigger companies are always good in sign as to how good a quality smaller company is, or what they've got is quite good. And I said on Twitter, they just announced a trading update and the acquisition of their French.
Yeah, how are they doing, old Escape Hunt?
Well, do you know what? I said this is the only leisure company I know that's expanding and improving operationally, because they're literally their EBITDA loss went down and from the previous year, which is to be expected. But I mean, the cash has gone up. The amount of sites they've gone up by 89%. And I just think I can't wait for the economy to open back up now, because there's demand there beforehand, and it'll come back. And I think domestic demand for anything, leisure, hospitality, from restaurants, everything will go up, because we can't travel at the moment because our vaccination program is so, unless you travel to Israel maybe, but our vaccination program is so good, so advanced, that there's not many countries in the world that's keeping up with us. So we're scared of bringing other people into the country with infection rates.
And they're purchasing their sites, aren't they? Looking for some sites which are really sort of like getting some good value deals.
Yeah. Well, and that's it. At the moment, you said you've got these commercial landlords taking 30% rent, if that, and most people are just leaving. All these shops that are don't have a big online presence are leaving. If they do have a big online presence, they realize, hang on a sec. Even Asda, recently just said, didn't they? They're going to lay off maybe 5,000 people because online shopping's gone massive. So you got all these sort of units in these big sort of centre of town sort of places that are going to leaving. So they are now negotiating non-stop with these places all around the country, looking for new venues. But it'll bounce back, Joe. I don't think it'll go back, like I said, office space wise. I don't think it'll go back 100% like it was before, but people will still go to the office. Maybe be a 60-40 split or a 50-50 or whatever, but people still go back, and town centres will not die, but it'll be a change, I think.
You and I are on the same page. I mean, actually, what I think will happen is that, yes, there won't be as many people going into the offices, but actually you'll still get quite a few people who want to live in the cities. Urbanization, because I mean, Mike, one of my daughters who's been staying here during the lockdown, I mean, she's not she's renting, but effectively living here whilst during the period. But she'll go straight back because she wants the nightclubs, she wants the actual social life, she wants the restaurants and all that kind of stuff. She may not be working in the office 5 days a week, but she'll still be living there. And what's quite interesting is that I've actually made, on the same basis as that logic, a little purchase this week as well in the UK's biggest listed private rental landlord called Grainger, and they've got about 9,000 sort of like 1-2 bedroom flats and apartments, and they've got small houses as well and stuff like that they rent out. And it's basically this is not the kind of stock that you buy. But it's basically it's like a inflation-linked bond proxy, defensive, trading at a 15% discount to net tangible assets. And the reason why I bought it is basically because of for inflation-wise, and it's been hit because what part of their occupancy is in city centres, and it's gone down to 90% from like 100%. But I still think they serve young professionals. I still think people are going to go back in. And what you've also got is the private rental sector. You've got a lot of sort of mom and pop owners, one person who is a landlord, except one site landlords, and they're leaving the market. I mean, that they used to have 20% of the market 10 years ago. They've got 9% of it now, and it's been replaced by professionals as the market's become more regulated and living standards. So for all of the Grainger sites, they've got broadbands, they've got communal areas for people and all that kind of stuff. So anyway, it was just quite interesting because you independently were talking about people going back into the city centres to have entertainment. I think they'll go back. I think there'll be a few of them, quite a lot of them, who will actually want to live there and enjoy themselves, because a lot of people have come out into the sticks and got bored, and then they want to go back into the sort of like that nightlife, that buzz. They may not work as much.
Listen, young people are hardwired to do that. That's how the humans. That's how the human population exists. They procreate. Exactly. That's what we're meant to do. And when you're young, you're hardwired to want to socialize and go out and find your partner. And that's what you're meant to do. So it's all us middle-aged people criticizing young people to want to party and can court down. They're hardwired to do that. They're meant to socialize. If they didn't, the human race would die out. So it's going against that trait, that need to want to do that. It's hard.
I bet you still party hard though, don't you?
No, I do. Look at it. What time do you go to bed? Because I get quite early, and genuinely, I think weekends I probably stay up. I'm watching something late, maybe a boxing match or something. I may stay up late, but generally, even the weekends I'm in bed before 11. I think.
Yeah, I know. Yeah. No, well, I was.
Weekdays is like it's 8 o'clock, 9 o'clock. I'm reading a book. That's me.
Yeah. Well, what time did you go to bed last night?
Last night, same time. I get in bed about put the kids to bed. They're 8:30, and I'm reading about 8:30, 9:30, and I'm sleeping by 10.
Oh,
because of this. I love getting in the morning, get my stuff done, and I want to see what news is coming out in the stock market. That's what I'm more incentivized by that now than staying up late. As you get older, you realize it's the mornings is where it's at, not the nights.
I'm only asking because I was actually up this morning at 11:15 last night. But I'm like you. When you get into the markets, you get earlier and earlier.
Yeah, exactly. So what time do you normally go to bed then?
I was tired, so I went to bed about 7:30, but I just couldn't sleep very well, so I sort of got up about 11:15. I've been working all the way through the night.
I didn't realise that you worked all the way through. Wow.
Yeah. No, I've been working all that. Yeah, I've already done a big day. Yeah. No, this is like 7 o'clock in the evening.
Yeah. Talk about new buys, right? I bought a new stock. I'm not going to tell you about it.
Oh, okay. Large.
But my members can see it on my website, sharepickers.com.
Okay, right.
Because what I'm doing, the thing is, my thing is small cap stocks, and I search a company and I share it, and because it's very liquid, a lot of people jump on it. The share price goes nuts, and then it maybe gets some sellers, and it gets very volatile. And so what I want to do is shut it down, let people research it, and I want to calmly talk about it. But I won't talk about it yet. But I like it. It's in sort of fintech. But in fact, talking about big companies, talking about the smaller companies, they've got that going on, and so it's very exciting. There's a contract happening there. But I will announce it in about a couple of weeks. But unless you remember,
what's the portfolio split? The sort of sector split and construction. I mean, is it all small?
So all small caps, yeah.
Right, okay,
I just find those quite exciting, though. And in fact, it's like it took me. I had to go out of my. I just mess around it. I said my area of semi-competence. I had to go out of that area doing the dash for cash to understand what I really liked, and I just jumped back in there. I messed around with some bigger stocks, and I don't really like them that much. And so I think you can get diversity in small companies. My portfolio, even though they're more volatile, it's just not that hugely volatile. As long as there are 8 stocks, I'm fine. So I got med tech. I got EV sort of tech, so gaming, esports, like I said, leisure. I got fintech, cybercrime. On the market actually is a retail sort of property portal. So in fact, I quite like the update. They came out with an update. Revenue up 20% from last year to 23 million. That's including they get a lot of discounts to customers during COVID and lockdown, all that stuff. So during a year where there's lots of disruption, people may have been viewing it online and stuff, but they still gave away a lot of discount. They still managed to generate 20% growth top line, and they went from something like a 9 million loss last year to 2.3 million profit. So I think it's very good. They said they're going to market more, so they may not continue that profit, but they still got 10 million in cash. You know, I don't think they can go back to the market. And they are getting traction. Jason Tebb, the new guy's in there, and he's saying we are developing products now that will deepen our relationship with estate agents. And one of them is very good. It's, you click a button and said, value my property, you type in your postcode, and it suggests what for estate agents that give you a valuation, you know. So that's very good. So I like that. And I think they are going to make, you know,
the amount of leads they get for their clients is just phenomenal, isn't it? I mean, we're talking millions a month, isn't it? I mean,
but you know what? I think it was, let me just look at the thing.
I think 2 million. I think they got sort of 1.8 million I saw, or something like that. In January.
And in fact, and even compared to now, Rightmove is 70 times the valuation, of course, of on the market, and they say they're going to an average of for January 146 leads per advertiser, right? In that month, which is cracking for even advertising. You get 146 leads, and I've seen a lot of testimonials on Twitter saying they're also better quality than Rightmove for some reason, and Rightmove only get about 170. So it's like it's not a huge difference, and is that worth 70 times? And they Rightmove charge £1,000 per user at the moment. The average for on the market is 133 quid. I think they're aiming for 300 quid, which would boost the revenue massively. But yet it's almost an eighth of the amount they charge. So you can see why people are moving from Rightmove. As long as it's effective, and it seems to be is effective, why would you pay £1,000 when you can pay close to 300 quid for the same kind of results? You know, so and that's why estate agents own 65% of it as well. So that's you know, the loyalty thing there. So I quite like it. I mean,
I agree. And I think the near-term opportunity is to convert the non-paying customers, isn't it, into paying ones. And if they do that, I think they can. Was it? What was the turnover? Was it? I had 23 down or something like 23.
Yeah, 23.
Yeah, I remember speaking to the CEO there about sort of 6 months ago, and he was giving me a sort of like, if they can manage to just convert their existing customers into paying, they get well over 40 mil. I mean, that's almost double where it is. And once you just get huge drop through on your profitability, then it just becomes another money machine, doesn't it?
Yeah. Exactly. They don't need to do a heck of a lot to achieve an uplift in the revenue. Like I say, I mean, initially they did introduce all these agents onto the free, pretty much, or an introductory fee just to show them the system. But now it's working. They say, well, you know, we got to charge them now because where else are they going to get that value for money? You know, come back to Rightmove. And there's also a website of, I don't know if you saw that. Someone pointed out to me, there's a website, estate agents have set up a website which is anti-Rightmove. It's like they're encouraging everyone to come off it because they say they don't really care. They just take your money, and because they're a big dominant player, they can do that. Their customer
sounds like Reddit to me. That does having to go at all the hedge funds who are short GameStop.
I know.
So I mean, another one which is obviously sort of software or technology orientated that has had a pretty decent sort of like lockdown. Who came out with results was trading update was Proactis. And I mean, they had just relatively flat revenues, only 3% down, but their EBITDA went up by 11%. And they've been having winning a whole bunch of series of contracts. And I know I mentioned last time, but they've managed and they've demonstrated that they're now been able to successfully replicate their UK and Dutch businesses overseas into France, Germany, and the US. And they just announced another B-paid contract as well. So the momentum's pretty good. Their top line growth in terms of new business wins has been strong, but hasn't yet fully been sort of like pushed into the sort of the revenues, and that's because they've had some legacy churn, which is now dropping away, and it's become really de minimis. And also, you know, on the revenue side, it's been hit by because of the lockdown. You've had transactional revenues, which is sort of like artificially pushed it down. So once you get those two short-term issues falling away, which should be next year. I mean, I interviewed Tim Sykes, the CEO, and he's pretty confident that if they can continue replicating that model, they're going to hit, easily double-digit top-line growth. And if you get that, you'll get a huge re-rating in the stock. They're currently trading at about, 46, 47p. But if you put just a modest market multiple of 4 times sales on it, you get over 150p, which is actually not dissimilar to where the shares were trading only 2 years ago. So if you get that top line organic growth, double digits, they're onto a winner because the margins are still very good. And you get a lot of operating leverage and a lot of cash coming down to the bottom line. So I would alert people to have a look at that because that is a good recovery play. And that it's on that cusp. It's like you're on the market, i.e., such that it's been it's come through it, and it just is a matter of just carrying on that momentum of what you're currently doing well, and then you should see the fruits coming forward in the next sort of like 12 months.
Yeah, exactly. Yeah, exactly. That inflection point of where the marketing spend will not take them into huge loss-making territory on the market, and I suppose and because the revenues go up to a point where they can afford that, and so yeah.
I'll tell you what I saw on the Vox website this week. They had Lloyds at #1 followed company.
Yeah, I saw that. Why was that then?
They had their prelims. They had their prelims, and we've obviously talked about it quite a bit. And I've obviously
Barclays there yesterday. They're now most followed. Barclays is there. Every now and again, you get Barclays or one of these big companies going in the top 10, 5 most followed. So yeah. So I was going to say how are the big? I was going to say how are the big boring stocks of Lloyds?
Exactly, you've dissed the big boys. And anyway, the banks. And the reason why I've been banging the table about Lloyds is that you've got a steepening yield curve. You've seen that in the US. You now started seeing the UK. And because they make their money on the net interest margin, that will actually stabilize and hopefully get, they'll be able to get them more money. But equally, what's happening is you're getting a steepening yield curve because the economy is getting stronger. And that means lower credit, or better credit quality, lower defaults. It also means is a better net interest margin. And also the reopening trade. You've got millions of people, households, who want to go out and spend on credit cards, and they'll go and spend on the house as well. And so you should get a better credit quality cycle, increase spend, and you've got a net interest margin improving as well. So you've got effectively 3 huge drivers for the banks, and they're still really cheap.
Do you still think though? But do you still? I mean, this you say improving credit cycle, but it's, with recessions, mostly the biggest amount of failings in the businesses happen coming out of it, don't they? Because right now, a lot of companies in lockdown, furlough, they can tick along, but once they have to open up and start spending, and that furlough drops away, and all the support drops away, is there still a bit of a risk? I think there'll still be a lot of businesses failing in the next couple of months, won't there? So will that affect banks?
But the majority of the people who've got so much money that they just can't spend it, and they're desperately keen to spend it. And so yes, you've got to be careful. You don't want to get sort of single company risk with some big corporate exposure. But I'm pretty sure. I mean, the bread and butter stuff for Lloyds, for instance, is mortgages to households, for instance, and selling credit cards into families. I mean, they haven't got a great big commercial sort of loan book, etc. Barclays have got a big one. NatWest have even got a bigger one still. But overall, you're getting more than a return just by Lloyds still trades at 25% to net tangible assets. Anyway, the reason why it was top at the most followed list is because people are starting to recognise is actually this is not going to go to the moon, this kind of stock, but it could easily do another 25% just to get back to net tangible assets. And likewise, the other one, which is again another recovery financial, big cap, which I own, which I've been talking a lot about it in terms of doing a restructuring, and actually the CEO Amanda Blanc is doing a great job. Is Aviva, and the shares have gone from like £2.20 to about £3.60, but they could easily get to net book assets, which is sort of like just south of £5 over the next 12 months because they're selling off on subscale overseas operations and going to concentrate on the UK, Ireland, and the Canadian interests. And the idea then is you basically invest and become faster and more innovative into those core areas where you have real scale, and any excess capital which they have, they'll probably do buybacks, and get anything, buy back anything less than sort of like net assets. So I mean, all I would say is that those two are steady Eddie big caps that, as long as you have a recovering economy, which frankly I'm sure we will, and the reason, and even if we do get a second or another nasty variant, there's no way the governments are going to not carry on giving stimulus into the economy. We've got so far, we're so deep in there.
But the thing is, variants. I was talking to some guy who's medical background on that, and he was saying even with the variants, even if you have these current vaccines, it does still stop critical illness in older people anyway. It may not stop mild illness, but it'll stop the beds filling up. Yeah. So and even then, if it's mutating slowly. So of course they mutate slowly. So by the time it gets to the point where it's hardly affected, they'll have new vaccines come out to address that anyway. So, but Lloyd's chart is looking quite good actually. It dropped off the cliff back in March last year, like everything else.
I know.
Came down, and literally it's been going along from 30 pence, pretty much bouncing on there. And then the 200-day moving average, of course, when it dropped off the cliff, the share price went way below that, and then it literally popped above the 200-day moving average, caught up with it in November of last year. See, that's foresight. That's the Pfizer time.
And actually, they've just announced their dividend. They're just paying the highest dividend they can do underneath the regulator. So, as long as you've got a 12-month view, I could see this over 50p. Net tangible assets is I think it's 52.3 or 52.5p. You could easily see it 55p by the end of the year, paying a dividend. You know, why not?
Well, do you know what? It's struggling. It's in 35 to 40 pence range at the moment, right? And it's tried twice to get above that 40 pence. It's never closed above it since. It hasn't done it since December. And so 2 months is trying to get. I think once it clicks above that, because it's due to. It's looking good for it. Once it gets above that.
I hope so. Anyway, so I've got some money in and Aviva.
Yeah, it literally. I mean, look at it. It's failed 3 times to break that 40 pence and just come back down and retest it. So if it gets above that, the algos will buy into it, and they'll be it'll push it back up. I think.
Yeah.
Cool. Good. Anything else? We'll talk about Paul.
No, I think we're there actually. We've done all the all my stocks. That's for sure.
You're taking your spreadsheet off there. So you're going through your spreadsheet.
Well, I was just having a look through and just making sure that I was giving investors an update, because I already do it sort of once every 2 weeks. But top level, all I would say with investors at the moment, you go through a bit of volatility, but the key thing to remember is the economy is improving. The yield curve is steepening. Long-term interest rates or long-term yields on 10-year treasuries out in the States are increasing simply because people expect the economy to carry on improving. So we're just getting effectively a reset of valuations of stocks that are high growth and more dependent on really rock bottom low interest rates. So this is nothing to worry about. Longer term.
No, do you know what? I put a poll on Twitter saying market drop opportunity. There's a little drop now. Is there up to? And I just put a couple of hours ago. 250 votes. 77% of people say yes. No, 23%. The people who are saying no are in cash, right? It's amazing. I see people on Twitter who are very bearish. I know you're in cash.
What's your cash holding at the moment?
Nothing.
Oh yeah, well, I've got 8%, and that's it now.
Yeah, you're right. We'll have wobbles, but the banks, several banks, and all this, they want the economy to recover. They have to get the economy.
They are all in.
Some money back. Yeah, they're investing in the economy. Yeah, I know they've got to. It's got to go in one way for them. It's got to go one way.
And they've spent so much. I mean, we're talking tens of trillions of dollars. There's no way they're going to jeopardize all that money just by pulling the plug early. They're absolutely just not going to do it.
Well, do you know what? A while back, I thought, why didn't the government invest in the kind of businesses? And I thought, well, in fact, when I talk about that, they are investing in the economy, because they get tax receipts, and if they don't get tax receipts, if businesses don't grow and make profits, they don't get tax receipts. So it's, of course, they're all in it, fully invested, and so they can't not see this economy get better. It's and also just when you look at the drop opportunity kind of thing, the stock market generally goes one way. Every time, I think the guy from Motley Fool said, if you look at it, it's like 1 out of 3 years this has dropped. You can on the stats kind of thing, but it doesn't happen like that. But you can say, so 2 out of 3 years, pretty much. If you're long, you can do well, And so if you look at the odds are on your side, if you're a long-term investor and on the long side. And so you can obviously be bearish all your life. There's people bearish, or there's a guy who's got so many followers, and all he does is bearish, non-stop bearish, scare people. And I unfollowed him after a while.
Dr. Doom.
Yeah, there's another guy. And I thought, mate, you can't, even after it sold off, he was still bearish and it started rallying. I thought, well, you're going to be right now and again, but the majority of the time, you're not going to be right, because everyone is creating businesses, want to make more profits. There's help for people from banks and all this government to create, wealth and jobs and all that. So it's all on the one side, pretty much. And you can be bearish now and again, but long term, the market's going up. So well,
I mean, I think you said it so many times. It's sort of like, when the facts change, you've got to change your strategy.
Exactly.
Otherwise, you're going to be King Canute and drown.
Yeah, and I think even now, the fact that people are a bit bearish is quite good. That's a positive thing, because when everyone's bullish, that's when you worry. But at the moment, there's a couple of bearish people, and the bears are being a bit louder. That's quite good. We have a correction. The correction is good. Let's off a bit of steam, and it can consolidate and carry on. It's not a bad thing. Cool. Thanks for that, Paul. And we'll speak in 2 weeks. And you can catch us on video and on the podcast, of course. But subscribe, hit that notification button if you want the video to your inbox. Speak in 2 weeks, Paul.
Yeah, thanks, Justin. Have a great weekend.